All attendees are in listen-only mode.
Good afternoon and welcome to today's Premium Account short form market update. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have over 15 years of experience in the financial services industry and a licensed securities advisor. The format for today's presentation, we look at a quick summary of the global macro outlook. We review the earnings results over the last week with a particular focus on ASX, Brambles, Fortescue, IAG, Origin, Toll, Lendlease and Mirvac Group. We review our equity buy orders and derivative overlays that have just been edited or made to portfolios over the course of the last week and conclude with a short-term Australian market outlook. The services that we provide are up on screen there. And if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Up on screen at the moment is a graph of the Dow Jones. Now, roughly the Dow's down about 5% from its peak early in August, as is the S&P 500. Traditionally, sort of this August through to September is a weak period for equity markets, and we've been positioning portfolios on that assumption. Our base case is that the Dow's worth about 14,500 points, which puts it about 13.5, 14 times forward earnings, and that's allowing for US earnings to grow somewhere around 8 to 10%. I think probably the outlook for equity markets is that we get some level of adjustment where we could see a further 3 to 5% downside. So we've got issues impacting the market from high oil prices as a result of tensions in Egypt and obviously the latest issues that the US government faces in dealing with Syria. We've got the political battle over the raising of the US federal debt limit approaching as well. And we've also got this issue of the 10-year treasuries in the US, and I'll just quickly jump to a graph of that now, and we'll chat about that in a moment. So the US treasuries, obviously if we go back 12 months ago, they were running at around 1.5, 1.7%, and it was really driving a strong recovery in the US housing market, and it's been one of the sort of shining lights within the recovery of the US economy, which obviously as house prices recover, so too does consumers' confidence, and therefore retail spending is strong or robust within that environment. So as the treasuries, whilst they're still low from historical standpoint, running at about just under 3%, they've increased almost a double from the lows that have been tracking at over the last 12 months. So there's increasing concern that it starts to diminish as a driver of US growth. So I've chatted about this in previous recordings at around 3%. I think that's probably the area where the equity investors start to get concerned about the impact it has on the US recovery. So we'd like to see those 10 years trend back down around 2.5 and consolidate. And I think that's probably the most likely scenario over the next 3 to 6 months, and that also sort of ties in with a slightly softer macro picture for equity markets in the months ahead. And bringing that back to the Australian equity market, what does that mean for the XJO? We're tracking at about a 4.5% average yield for the S&P 200 stocks on the ASX. I think that underpins valuations. So as with the US, yes, there may be 3 to 5% downside. We see support at around 4,800 on the index. I still have the view that portfolio allocation needs to be skewed towards defensive names, still skewed towards those companies that generate US earnings when converted back into Aussie dollars, get the marginal uptick. If there is any disruption at a macro level, we're likely to see the Aussie dollar remain under pressure, and I think that offsets some of that growth story in some of those US dollar earners. So that's our focus from a portfolio allocation standpoint, given that PE valuations are still high from historical standpoints. I think we need to complement those equity positions with tight covered calls, and as I get into a couple of the names in today's report, we can review where that derivative strategy sits. From a forward earnings standpoint, we're looking for, I think maybe the market's a bit optimistic, or analysts are a bit optimistic for 2014 earnings growth for our market at around 10 to 12%. I think that number's probably really more like 4 to possibly 8% at the absolute upside. Some of that growth will come from resources. The outlook looks a little bit better for the resource names, but certainly a lot of the industrial stocks and the defensives are trading on high PEs, and a good amount of the earnings growth is already priced into those names. So on that note, let's have a look at the companies that have just reported in the week just gone by. So ASX was the first one. The earnings came in line. So 2013 earnings before interest and tax came in at 440 million. Net profit after tax came in at 348. That was essentially in line with the same previous corresponding period last year. That was what we were looking for. Our strategy here with the ASX is we're not looking for a huge amount of earnings growth into 14, maybe somewhere around 3% would be a good result, but the stock trading on a 5% dividend yield with reasonably solid certainty around earnings at least being stable in somewhat regardless of the macro environment over the next 12 months, we're drawn towards owning ASX and selling the covered calls up at around $36, $37. We've been doing that over the course of the last week, collecting an extra sort of 45 cents for those calls. And if we add that to the upcoming dividend on an annualized basis, we're generating over 10% cash flow for ASX. The other name that reported during the week was Brambles, so they're slightly disappointed, not necessarily from a 2013 earnings standpoint, but from an outlook or a guidance statement. For 2013, we were looking for just over $1 billion of profit. The company delivered that. The positive, I think, is that the recall spin-off is going ahead. The negative is that the outlook was downgraded from around 8% earnings growth down to around 4 to 5% earnings growth. I think that could be a little bit conservative. We're buyers of Brambles at or near this level, selling calls anywhere in the sort of 9 to 9.50 range. It is coming up to paying its dividends soon of around 13, 14 cents. So we continue to acquire Brambles at or near these levels. Fortescue reported its result also, so this was a reasonably strong result above expectation, but with the stock sort of, or in particular iron ore, back up at 140 US a tonne after rallying from 90 a tonne 6 months ago. I think it's pushing up against the top end of its current valuation range, both iron ore and Fortescue. We look for the price to consolidate and then maybe in line with our view on the broader resource strategy where we get a rally from December through to January as we get more of a synchronized global growth story where GDP starts to pick up, emerging markets look a little bit better, and we'd look for that next leg higher in the commodity stocks. So whilst we're skewed towards owning BHP and Woodside Petroleum as our preferred commodity names in portfolios, to the extent that we do have any exposure to Fortescue, we've capped it out around this 470 level, looking for the stock to recover it with the real sort of upside growth in commodities in portfolios coming through BHP and Woodside. IAG reported their results, so the insurance margin came in at around 13%, which was roughly in line with expectation. Net profit after tax was slightly ahead. The market had sort of priced this one for perfection, so no real surprises. The company sort of met those expectations at around about 12.5, 13 times 2014 earnings at about a 5% dividend yield. I think the prospect of the company delivering about 5 to maybe 8% EPS growth in 2014, the stock looks attractive from a buy-right standpoint. We don't see a huge amount of capital appreciation from here, but equally the downside risks are pretty limited in IAG. Origin reported their result. Now they met the lower end of the guidance range, so roughly $760 million in net profit after tax. There were tentative signs that competition's abating, which should allow for margin restoration. So one of the issues facing Origin's been a combination of capital expenditure blowouts up with their LNG projects up in Gladstone and also tighter margins within the retail side of their business. So I think on both of those fronts, the commentary out of the company was positive. That's really why we've seen the pop in the share price. It doesn't relate to the 2013 earnings, but the real story for Origin is really from 2015 through to 2017, we could see about 30 to 40% earnings uplift from current levels as we start to see these LNG projects come online. But in the next 6 to 12 months, I think with the stock trading on a 4% dividend yield and around 16 times earnings, between $12.50 and sort of $13.50 probably captures the upside for Origin over the next 6 months. Toll Holdings was another name that reported during the week. Earnings before interest and tax come in at $426 million, which was a positive result at around a 5% dividend yield, again trading at about 13 times forward earnings. The stock's fair value earnings growth into 2014 is probably fairly limited. There are some risks from the perspective of the Australian economy being slower than anticipated, mining activity falling off, but in saying all that, I think the outlook for Toll would be for flat to low levels of earnings growth into 2014 at a 5% dividend yield. The stock should continue to be well supported in the sort of 5.25 range. So we've been buyers of it at or near this level, and we're selling calls up at around $6. I think that captures the recovery range for Toll. Lendlease reported their result. Keep in mind, Lendlease had downgraded their outlook a number of months back, so the company came in at the upper end of that downgraded guidance, but really the positive news here is the earnings outlook for Lendlease and the commentary from management suggesting that the company's capable of growing probably somewhere in the highest single digits over the next 2 to 3 years, and with the stock trading 9 times earnings or 9.5 times earnings, it's attractively priced relative to the rest of the market. So we've been mild owners of Lendlease at or near these levels. We see full value back up at around $10.50, $11. So look for the stock to consolidate and then ultimately move higher over the next 6 to 12 months. Mirvac Group delivered their results, and I thought this was actually quite a reasonable result. Net profit came in at $377 million, so up slightly on the same previous corresponding period last year, and the company gave positive guidance for about 7% earnings growth into 2014. Also reporting today was AGK, so they delivered a good result, and we've been advocates of owning AGK on this pullback here. At around $15.50 to $16, we start to see the stock full value at around, again, 4.5% dividend yield, about around 15 times forward earnings. At around $15.50, that captures the full upside there for AGK. They're about to pay a dividend around 34 cents, so I'd expect the stock to continue to be well supported coming into the dividend. Woolworths delivered their earnings result today, so in line with expectations of about 5% earnings growth. They made a slight increase to their outlook into 2014, where they were previously sitting at around 4 to 6% growth. That's now been upgraded to 4 to 7%. The dividend's up slightly. Woolworths has been a name that we've been accumulating over the last few months. I think this sort of theme that we're running in portfolios of being long these defensive names, and I'll just review some of them. So Woolworths, as I mentioned, we're owners of that at lower levels, as we are with Wesfarmers. They delivered about 6% earnings growth, so slightly disappointed where the market was looking for about 10%. Again, keep in mind that the PE that these names are trading on, so Woolworths trading at about 16, 17 times forward earnings. Wesfarmers trading at the same, around 18 times forward earnings. They're expensive. The dividend yields are tracking at around 4.5 to 5%. But through adding that covered call strategy to these names and allowing for some capital growth in the underlying shares, we're increasing that cash flow from around 4.5%, 5% to 10% through the call premium and the dividends, and again allowing for some small capital growth. So Wesfarmers we like. Amcor's another name that we've been participating in, so they pay roughly a 20-cent dividend in the next week. We've been owning this at or near these levels, but again selling the tight covered call at around $11. We've been collecting an extra 22 cents for that, so again boosting that annual cash flow to in excess of 10%. We're looking for this upcoming spin-off of the Australasian packaging distribution business. I think that'll help to unlock some value and provide exposure to the faster growing international and emerging markets divisions for Amcor. So we do think the stock's expensive, but the downside risks are limited, and we're looking for the stock essentially to move sideways. And a lot of these names fit into this theme where we're wanting to own companies that have US dollar earnings, as we see that in the prospect of a weaker macro environment and risk aversion creeping in, where we see money flow back into US dollars and the Australian dollar remain under pressure. At the margin, what that'll mean is better returns for these companies that are generating a substantial amount of their earnings in US dollars. So Westfield's another example of that. From the dividend side of things, just in the last week we picked up the dividends on Coca-Cola. So there was a 2.5 cent special dividend and a 24 cent standard dividend there. We do own this, and we've sold covered calls to complement the cash flow out of Coca-Cola. If you're not familiar with the latest announcements out of Coca-Cola, the company missed earnings expectations for 2013 and guided towards up to sort of 5% fall off in earnings in 2014. We think what will change here is the company will really start to tighten its cost control at around a 5% dividend yield. We think that the company can deliver some return to growth of maybe sort of 2 to 4% earnings growth in 14 and 15, and therefore the stock starts to present value again. So we've been mild buyers of it down at these levels here. And also going ex-dividend was Origin Energy. So we've collected the dividends there on Origin of roughly 25 cents, and as to has Woodside gone ex of around 92 cents, which, as I mentioned, Woodside and BHP are our preferred commodity plays. All right, just to conclude today's presentation, it is a short form webinar, and we'll return back to the broader top 50 stocks in next week's recording, where we'll do a full overview of the PE valuations, dividend yields, and our portfolio allocations, along with derivative overlay on the stocks within the top 50 that we're participating in. So to conclude with that short-term market outlook, again, our base case is that there's a number of issues that the global economy is going to face over the next 2 to 3 months that could result in somewhere between 3 to 5% downside risk to equity markets. So we look for the Dow to find support around 14,000, and on our market potentially down to 4,800. But given the low bond yield environment globally, we think equities still provide a very attractive asset allocation, and ultimately central banks continuing to provide the stimulus and policy response needed to underpin an ongoing recovery in global property prices and equity valuations as central banks attempt to sort of reinflate the global economy, should lead to an environment where we get more of a synchronized global GDP pickup in the early part of the new year. Thank you for listening in to today's recording. I look forward to speaking again next week.